today's webinar. Today we are going to discuss the levels for Nifty, Bank Nifty, what is likely to happen in coming days, and what type of strategy that we can follow both for trading as well as for investment, and also the option strategy. Now, yesterday we were discussing about the big picture scenario of Nifty and Bank Nifty. And Nifty, we said that there is a tendency, fundamental factors are still loaded against the equity markets. So there's a good chance that this rally can halt at some decent level and then fall further. So Nifty, we projected that probably it could be the rally could extend itself closer to the 16,000 mark, 15,950 or 16,150 also, and then probably from there it could fall right up to 14,300, 350 levels. This is what we said yesterday. Now first we go to the chart. Now if you look at the we have taken the Fibonacci from the recent high, which is important high of 16,000, this particular level, which is 16,793 to the present level, which is 15,183, the last important low. And based on that, the Fibonacci projection that we are having right now is this. That is the first resistance, important resistance which can come right now looks to be the 15,798, which is a 38.2% retracement. Generally, that can be an important reversal area, 15,798. Then if it still rallies, it could be 15,988, and this 15,988 is also the 23.5% retracement from 18,600 to 15,186. So this 15,988 can become a very, very important resistance, even if 15,798 is going to be taken off. So very closer to the 16,000 is likely to be the important resistance area, from where again the market can take a turnaround. But as we said yesterday, that since we are getting some higher highs and higher bottoms and also higher highs, so it looks as if we could be having some sort of a pullback rally, and the pullback rally can be closer to 16,000 mark. And we also illustrated last time that normally the on a close to close basis, on a monthly basis, normally the close is within 3 times of the option price or the money option price. Last month and even now, it's around closing at around say 375 to 400. That's the option ATM forwards, and we will show it to you. So that into 3 approximately makes it something like 1,150 to 1,200 points, which means that on 30th June, if you compare the 30th June price of 30th May price, it was 16,660 or so close. So if you take 1,200 points, it should be 15,400 or so. So near about range for Nifty to close for 30th June, that is next coming Thursday or so, should be closer to the 15,400. Now when it fell much below that, it was looking like an opportunity for a short-term pullback, and that is what has happened right now. So the expected rally will peter out at closer to the 16,000 mark, and from there, if it is to take off the last important low, which is the 15,150, there can be a further fall which could target right up to 14,300. Of course, intermittent supports will come at 14,850 and all. There will be some bounce back here and there, some 200, 300 points of bounce back will always come. But nevertheless, we could see the important support emerging closer to the 14,300 mark. So how do we play this particular opinion in the market? Now, the short-term trend is up, but the long-term trend is down. So we have to look at which one is more comfortable for us to do, because normally, of course, when you do certain things, the market can also make a turnaround at some stage or there. So we should know beyond which we should not carry this position. Now, if you see that, I think probably in the 78.6% comes at 16,446, and even 61.8, 16,177. So very, and also there is a gap closing area. So we don't expect that even if it doesn't stop at around 16,000, chances of above 16,200 is a little remote. And also we have seen Nifty on point to point basis. Normally, there is a chance of 1100, 1200 points on an absolute point basis. Percentage it could be different. Normally, on a point to point, most of the time, it could be well within 1100 points. So if that be the case, then 16,200 should be a very important resistance, even if it pushes to that place. So only above that we need to be worried about it. So whenever we do an option strategy here, we should keep 16,200 approximately as a stop loss, okay, so that you don't lose much. Now you have to look at whether you're going to do of a slightly higher time frame, that is less. Normally there's a tendency to do a weekly option, but in order not to lose too much of time decay, because in the short term the market can be up, as we said. So potential that it could rally right up to 15,988 and then probably fall. But to work for at 200, 300 points, there's no point in looking at option, because there's a chance that the expected rally itself may not materialize to that extent, and it can probably decline even from the present levels also, because if things turn out to be a little worse as far as fundamental factors are concerned, highly good chance that the turnaround can take place even from these levels. It did not go up to 16,000 levels. Now if that be the case, then doing even for a short term pullback for a say 200, 300 points from here, we will be will not be able to even cover the option expenses, because even a weekly option today is going to be around 150, 160 points, and so to cover that and make profits is going to be quite limited, unless we are looking at some sort of a structured option where we are not spending too much on the time decay, but we are trying to save some money as far as the resources are concerned. That is, instead of doing a futures, whether we can do an option spread or like that. So unless we do something like that, there is no point in wasting too much of premium in a very short term call. And the only way that you can look at the short term call probably is that expecting that the 15,550, 560 levels or 15,000, say for example 15,350 or 350 may not happen. So you can, for the time being, you can do a sell spread option between 15,000, that is for next week or so, or even for a month or so. What you can do is that you can look at now 15,000, so market being at 15,700, so you can look at something like 15,500, 15,300 option spread, or 15.6, 15.4 option, because unlikely chance that it can within a week 15,350, 360 is a good support place right now. So when we hope that probably there can be a pullback towards 15,950, so 15.6 and 15.4 sell option, that is sell put, and this is buy put. Sell put of 15.6 and buy put of 15.4 looks to be a very reasonable proposition to do that. And of course the second strategy could be for the short term. It could be sell 16,000, now 15 it is around 15.7 or so. We don't think so there will be much of a premium, but if you could do that, sell 16,000 call and buy a 16,200 call. So this is a possibility for a very short term nature, so that it's a little bit on the safer side. So let's look at the option price now for the weekly as well as for the monthly one. The options chain here. So we'll look at the weekly, that is next coming week, which is the 30th June. Now as things stand, because tomorrow the prices could be different, that is on Monday. So if you look at the 16,000 call option, it is 42, and 16,200 call is 13, which is 42 minus 13 is approximately gets 29 rupees here. and 15,500 put is 89, 15,300 is 47. So you get something like 42 plus 19, around 61, 62 rupees you're going to get. So 62 rupees you're going to get, so which makes the break even 62 rupees you're going to get, and you're going to get a break even which is 15,500, 15,430 here, and there it is going to be 16,060. So the maximum loss probably could be 140 rupees. Maximum loss could be 140, but highly unlikely to materialize in the short term, because there is a chance that you can have some up and down movement, and this can the premium can shrink because it's only doing for only 3-4 days, right? So the premiums can shrink faster and can give you the profit. But nevertheless, if you go only with the present trend, which is a short-term uptrend, then you don't need to do the call option. You just need to do the put option side, and you get some 45, 46 rupees. And if it starts really getting much below the 15,400 or 15,350 levels, you can put in a stop loss if you want. Okay, because below 15,350, then there's a chance that you may make a full 200 rupees loss. Instead of that, you can make a lesser loss and come out. So one thing that you can do is 15,000 for the present situation, you can do a 15,500 put sell and buy a 15,300 put, and this combination will give 42 rupees for this coming week, that is for 30th June. For 30th June you will get this. So good chance that you may make money, because if it starts to rally, this will shrink and you can make the profits. Now if it starts to go below 15,350 or so, probably you can remove that and make probably some 100 rupees loss also will be there. And before that, if you make the profits, if it comes down, the 42 rupees comes to 10 rupees or so on a rally, you can just remove that, make the profit and leave the trade. So this is one option that you can consider for a short-term period. Now for a longer term, we know that is for a period which is going to be into July. It is better to wait for some time to see how much this rally that is going to take place, and let us say it comes closer to 16,000 mark as we envisaged. That time the option premium right now at the money is going at 375. So let's presume that at that point of time it will come to 350 rupees if it is going to happen faster within a couple of days time or so. So 350 rupees. Now at around 16,000, paying this option price of 350 for the full month of July can really make sense, because you have a break even which could be 15,650. You can have a break even which could be closer to the 15,650, and if there is going to be a fall from there, probably within a month, it can fall back straight away to 14, at least minimum 14.7, 14.8. There could be a chance of a fall which will be 14.7, 14.8 or even 14.3. But assuming that within a month 14.3, 1,700 points may not come, 1,200, 1,300 points if you take also 14.7, 14.8 can be the first important support if it goes up to 16,000. So you will have a good chance to make something like an 800 rupees or so profit. 800 rupees profit or so is a very highly good chance that you will make. Now another thing that right now what's happening is that the people will be looking at when to do straddle and all those things. Now if it goes to 16,000 or so, I would suggest only buy a put and pay the 350 rupees. So sometimes if you say that the market can take you by surprise and it can go on the upper side also, then in that case you just see how you can retrieve that 350 rupees. One way is you put in a stop loss which I told you is above 16.2, so that you don't need to wait below 6.2, so there will be a small loss. There will only be a small loss, and you're going to do this trade maybe you will lose something like, it may come down to 250 rupees also at that time, above 16.2. So 70 to 80 rupees loss can be there. 70 to 80 rupees loss maximum will be there. So you can do this trade at around 16,000 and put, and no, look towards keeping 16,200 as a stop loss. Now you want to probably reduce this, probably, so this 350 rupees or so you would like to reduce this. So let's look at the premiums right now. Now for the month of July, we look at the July month. Now when it's at 15.7, the around 1000 points down is 100 rupees down, 100 rupees down. So the difference that is coming now is 375 minus 100 is 275. So similarly, you may get something like 275 rupees when it goes up on the upside closer to 16,000. So instead of you trying to look towards too much of a this one, that is in order to reduce the premium considerably, you can do a 16,000 and 15,000 put spread. 16,000 and 15,000 put spread you can do. So so 16,000 and 15,000 put spread can do that. Okay, so this is one alternative that you can think, that in 16,000 you can look at 350 rupees. Okay, put option. 16,000, 15,000 you can try to do something like 275 rupees put spread option. You can do that. And you can also look towards 1:2:1, a butterfly type of option, because getting much below 14,000 and all, I mean, like, it's a little difficult, but anything can happen. But you can do 16,000, 15,000 and 14,000 put. And probably right now you may have some 150 or 175 rupees only to be paid for that if you do that. So which is also a very reasonably good proposition to do that. Good proposition to do that in order to reduce the premium substantially and not to lose too much on premium. You can also think about that. That is, you can think about a 16,000, 15,000, 14,000 spread. 1:2:1. And probably at this stage, this could be 350. Sorry, this is now at 375 approximately. This could be 100, and this could be very less. So 175 to 200 rupees net it can come. So also a very reasonable chance to make money there. Very reasonable chance to make money there. So this also you can look towards that. And probably you can if it goes up then above 16,200 or 16,400, you can remove this. Probably the loss will be quite less because you have done a 1:2:1. So maybe the loss will be very, very less. 20 rupees, 30 rupees loss only will be there. And if it comes down, definitely it will improve your chances of making profit there. So this is another structure, butterfly spread type of structure. You do closer to 16,000. You do 1:2:1, 16,000, 15,000 and 14,000 for the entire month and leave it there. And if it goes above 16.2, you can put in a stop loss. Similarly, you can do a put spread and also put in a stop loss there also. So these are good alternative structure, that is buying a plain put, buying a put spread, buying a butterfly spread, because we are expressing all the opinion in terms of a downside, and the downside we are trying to restrict ourselves up to, if it goes up to 16,000, then in that case for a 1 month time period we don't expect like the option price, there's only a 15% chance that it can be much below 14.7, 14.8 by end of the month. But we are giving an option right up to 14,000, so 16, 14.5, 14 will work. But in order to, suppose if you want to reduce the premium significantly and around 16,000, and you don't expect more than 1,500 points fall. So right now also 1 month for it is now at 16. It was at 16.6 and now it is 15.6. It is at 15.6. Okay. So we have, approximately with 2-3 days to go, with market slightly on the rise right now. So there's only 1,000 points. Okay, so 1,000 points of fall from that particular peak for 16,600. So on a close-to-close basis, we are talking about. If that be the case, you're putting it around 1,000 points. Then in that case, no, you can even go for a slightly higher thing. That is, you can go for a 16,000, 15, 14, 15.3, 14 6 option. Okay, so probably you can just reduce the premium quite significantly. Now, if you look at the same thing right now for the 700 rupees difference, now for this for July. Now 15.7 and 15.7 is 377 and 15,000 is 152. So approximately it's only 71, 72 rupees right now. 15.7 and 15 is only 72 and 14.3 is 56. So 120, 120, 125 rupees. So you are further reducing your premium that you're paying here, which is again a good thing, because we don't expect more below 14.3, right? So even if you do a 15.7, 15 and 14.3 and leave the trade, I think it's a very reasonably good chance that you will not lose money. Okay, and if it comes to 14.3 also, and it looks like breaking that particular position also, then in that case you can you would always know that even at that point of time, even at 125 rupees you will not lose, because you will always know the value will be closer to that 125 rupees at that point of time, so you will not lose. So I think placing yourself at this level of expecting that probably it will not be more than 1,400 points of fall, you can do the trade. Now let's look at the previous months also, in the recent periods, of course. That is the on a month-to-month basis. Of course, the this is May 30th. This is May 30th. This is the so May 30th is this 16,660, and April 30th. So April, either you can go for this previous day or this. So it was around 17,000, 17,100, right? 17,100, and in the next month it was 16,600. So it was only 400 points. It was just 400 points. Market fell, but it rose back. It rose back. Okay, so similar thing is happening right now. And so let us say if on 30th June, if it is closer to 16,000, then the fall would have been only 600 points. 600 points. So better to do for something like 700 points or 800 points difference and still not lose much of money. Now, suppose this is the 4th May, and so this is, let us say, month end. This is April. So let's look at the March 29th. March 29th, it was 17,320. Okay. So March 29th, if you look at it, it was 17,320. 17,320. And April, 17,102. So it was only even when in the rising market, after it fell, it was only 220 points. So better, I think it looks as if we should give a premium which is not more than 100 to 125 points, right? So better to do something which is I would say put it around the 700, 750 points, and even only except for 1 month, probably this particular month, let us say this was March, this was March 30th March. So we will look at So February end was 16,793. 16,793, and so 16,800 you take. So 200 plus 500, 700 points. Even on a rally, it was only 700 points. So 700 points, I think no, the rally was not more than that. So on a close to close basis, we are not getting more than 700 to 800 points, which means getting more than twice the option price itself doesn't happen that much. Only less times it happens. Most bullish case or most bearish case happens. So if you look at the price right now, 16,660, when it fell very substantially down, we could have expected that 375 into 2, 750 points, so which means 15,900 or 950. Okay, so even last time when it was 16,600 points, it was 16,600, right? So this was in month of May. It was 16,660. And today it is at 1,000 points, and still we would have made money, because you would have done 1:2:1 at 700 points difference. So still we will be making money, and the moment it rallies a little bit towards 15,900, I'm sure that we will have a good decent profit. And so if you look at it, this was a very clear case where the extremely oversold condition happened, because normally it is expected to be not more than 3 times the option price itself. With getting it below that, it's going to be a little difficult. 2 times option price itself is not going to be that easy to bear. So the best thing is, when it came down to that extent of no more than 2 times, then in that case we should have gone a little bit careful about any short positions here, and we should have been prepared to take profits of any short position and wait for a pullback before we do anything. Similarly, it applies the same place. Now let us say this particular let's say this particular day, this is the lowest point. Better always not to check with the lowest point. It's always better to check with some intermittent points. But nevertheless, even if you take this place 15,293, which was on 17th June, so by end of this by 17th June, we don't expect more than 700 points. So okay, so if it goes above 15,290, 15,990 in a very short period of time, then we can expect by 17th June it will come down. It will come down also there. So that is one point you can make a mark of how much you can look towards this. So even if you take 13th May, and this was 15,782. So let's look at this is 13th. It was almost a flat. Proposition, and no, we would not have lost anything by doing this particular trade. Also, maximum it would have been just say 100 rupees or so. But that 100 rupees, even 2-3 days before, you will have some money left. So the loss could be very, very slim. Loss could be quite slim, even in that particular case of a decay. Now, what we can probably attempt to do this is that a little bit of a rolling over can be done at some crucial level. You can move it according to the market up to some extent. Now, when I say that, what we are saying is, suppose let us say you do this option as 16,000. Of course, I am saying that above 16.2 don't keep this trade. It will not be of great use above 16.2. Now, you can do one thing, that is, now since you are paying 16.2. This one, that is above 16.2, there is a chance that probably you may not put a stop loss. So what you can do is that you can you do this butterfly option, and probably between 16.2 and 16.3, buy a call option spread between 16.2 and 16.3 for 100 rupees difference. You may pay some 30 or 40 rupees. So if the market rallies, you will at least get some 70 rupees or 80 rupees their profit if it just closes above 16.3. So no, the chance the loss will come down to 70 to 80 rupees or less than that. For a 125 rupees, instead of 125 rupees paying, you may end up with some 70 rupees or 80 rupees loss. So you can even reduce that particular loss also quite significantly if you want. So the entire thing that you can look towards, I mean, like, no, doing this particular trade is to sense the direction of the trade and then install certain trades in such a manner that it will be quite profitable for you to do. So whatever type of strategy. Now we talked about the pure option, which can be done when it goes to 16,000. We have also talked about doing about a put spread, and also we talked about the butterfly spread that we can do. And for a shorter period, we have talked about selling a put spread between 15.5 and 15.3. Now let us say I've been maintaining that once you do these trades, since above 16.2 it is unlikely, so you put in a stop loss above 16.2. That is what we are maintaining right now. Now because you don't need to lose too much on any of these trades, so just put in a stop loss above 16.2. Now those who don't want to do that, I mean, like, you don't want to, because you would like to test it up to that, then in that case you do rollover. Now the put spread that I told you, let us say you are doing a put spread between 16,000 and 15,000. Let us say you are doing a thing between 16,000 and 15,000, and you are paying a premium which is approximately 275 rupees. Let us say you are paying a premium which is around 275 rupees. Now what you can do is that you can just try and ensure that the option, if it goes to 16.2, chances it can still fall from there. So you can roll over the option by taking that loss, because if it moved up, the loss will be according to the delta of the options spread that you have done. So between 16 and 15 you have done. So when it goes to 16.2, there is a chance that you may be losing 30 or 40 rupees. And that too, if you have paid 275, it could become 235 or so. But again, when you do the same trade, maybe it will be 250 or 275. I don't know exactly what the amount at that point of time. It will be slightly lower because of the time decay that happens. So that will be slightly lower. So to that extent, it will be compensated to that extent. Now, the rollover, after you do that, when the market starts falling, you will have a profit which can come a little faster, because you have moved the strikes to a higher side. You have moved the strikes to a higher side. And then if you want, you can keep just rolling it down also. No, what I mean to say is this. Now let us say now say at 16,000 levels, you have done the spot is 16,000. So you have done a 16,000, 15,000 put spread. Okay. Now it goes to 16.2. Goes to 16.2. So what you do is you just remove this, whatever loss at that point of time you take it, and make it a 16.2, 15.2. Probably the option price, which we are not talking about, 375 minus 100, which is 275. This 275 itself can come down. This 275 itself, when you do this, depending on the time period, if it takes a little more time to come, maybe this 275 can become 250, something like that. But you will have some loss of the 16.2 to 15.2. So net and net, there will not be much of a difference. Okay, there will be some 20, 30 rupees difference can be there. But what happens is, right now you are positioned yourself from 16.2 to 15.2, right? From 16.2 to 15.2 you are positioned yourself, which will give you a better reason for you to probably look towards making the trade more workable. That is more profitable. So you can do this trade, and you can do this trade. But initially do it around, because you don't expect 16,000 to be crossed very decisively. So closer to that, you do a trade like this, and then if you want, you can just remove that and put it like this. You can put it like this. Okay. Similar thing that you can do for butterfly also. But I think for butterfly, since there won't be much of a loss, going from that particular level to a higher level, better not to disturb butterfly too much. I think because there's a chance that it can go a little bit down, it can come down, and it can give you a decent profit. So I think we should not try to do too much as far as the butterfly is concerned. If you want, you can just remove the trade or wait for the trade to make yourself profitable, because it's definitely on a downward trend. Market is on a downward trend. Now you are doing it almost 1,000 points from the bottom. Very good chance that it can come down. Very good chance that it can come down. Okay. So after it comes down, you can look at some strategy of how to make it work. You can think about certain things later on. So right now, just you don't need to disturb anything. Just do the trade and leave it and see. Because in the case of butterfly trades, or even in the case of put options trade, what you should normally do is, how do you position yourself first? At what level you should position yourself first? Now, you should always position when, if you want to do a put, the trend should be down, but there should be a correction, and the correction should be at least a decent level, and you may sometimes get 500, 600 points only on the upside. Sometimes you may get something closer to 1,000 points. Last time it went up to 1,000 points. So whenever you place yourself the top position to do that, it's fine. Now, a lot of people think about, why don't we do a straddle? Now the straddle, why? See, normally whenever the option prices are being given, it's almost to ensure that you don't make money. In the sense that very difficult for you to make money. Now the reason is very clear. Now, even in the market over a period of time, let us say if it is normal distribution, 50% of the time it will be up and 50% of the time it will be down. But generally, over a period of time, it's 55% on the upside and 45% on the downside. Now, when you suppose if you are buying a call, let us say 50% of the time it doesn't work. So that means 375 rupees every time it's gone, right? Now, remaining 50%, it has to take a profit which should be double the option price, right? So 375 rupees into 2. So that means it has to be 750 rupees on the upside whenever the upside happens. So if you look at the longer period of time, the straddle will not produce a profit if you keep it till the end. If you keep it till the end, most of the time it will not. So you can just check the statistics also. Only some rare times it would have made money. At the same time, we cannot sell a straddle also, because the fear at some stage, during like a pandemic time or last one, when the fall happens, you will get unnote. You'll get unnote. So that is the reason why selling the straddle you find it a little difficult. But instead of keeping it till the close, if you take the profit whenever it has exceeded, when the total amount is exceeding 2 times of the option price. When I'm saying that, at 16,000 you are doing a put option as well as call option, and you are paying something like 700, 750 rupees. So the break even is going to be on 15,250 this side and 16,750 on the upside. Now 15,250, we are saying that it can collapse, and it can come from 16,000, it can come to 14,800 or so. It can come, and then only it will go to 14,300. So let us say it has gone up to 16,800. Getting it much below 14,800 within a month is not going to happen to this one. So whenever it happens to 14,800, that's time you should just take the profit. So this month also, if you see at 16,600, if you look at the option at that point of time, so 16,600, then it came down up to 15,200, so 1,400 points. So if you have done the option somewhere here, you would have made money. So that means whenever you want to do the straddle, you should wait for a good amount of uptick before you do that. In that case, you may say, then why do you buy a call when it has already come to the rate? That is the reason why we have not suggested in the first case. But still, if you are risk averse and you want to do that, then you do that. But instead of spending too much on the call side of 350 rupees, just try to see, that it's the Above what level? Probably the market can rally, and it can probably you want to take off the 350 rupees put premium that you have paid. So in that case you should have a call spread which is around 400 points, 350 points or so, and pay some premium for 150 rupees. So the maximum loss could be something like 150 rupees or so. So what you should basically then look towards doing that is but that will bring down your profit. But still, as I told you, that when you do a 16,000 and 15,000 put spread, at this point of time, for the 1,000 points difference, you will paying something like 275 rupees. You may pay something like 275 rupees. Okay. So you then in that case, what you want to do is that if it comes down below 15,000, you don't mind because you're getting some 750 points or so profit is there. Now you want, in case if it moves up, you don't want to lose too much in that. So in that case, what you do is you buy a 16,000 call or 16,000 because okay, you 16,000 300 price. So let us look at the 300 price difference. What is the call option premium price right now? See, 15.7 is 387. This is 241. So 140 rupees will pay. Approximately 140 rupees will pay. So net effect you will be paying, instead of so much, you will be paying 275 plus 140. So you will pay 415 rupees, and if it moves up above 16.3 on July, so you will get this 300 rupees here. So the maximum loss is something like 115 rupees. 115. But your break even is going to be 16,000 minus 400, approximately 15,600. Reasonably decent trade. Only thing is unnecessarily paying 140 rupees here. So instead of that, you can always look towards trying to do some rollover up to 16.2, and if it still starts going above 16.2, you can just think about exiting the trade. Okay. Now in that particular case, you can always work out some way of where you can keep the sell side, because if it is going to go above 16.2, getting below 15 is not going to happen immediately. Chance that it itself can make a profit, so you don't need to remove the 15,000. You can just remove the 16,000 and probably leave the other trade, so you can make profits over a period of time. So that all those things you can look towards working it out. So you can also look towards probably as it goes up, you can just keep lifting the sell side alone a little bit, and then keep pushing the sell side alone when it comes down. So you can do thing up to some extent, so that you the 250, 275 rupees, you try to ensure that probably you can get some that is the at least 100, 125 rupees or so. You can try to recover by doing that. So that is one way of looking at it, the type of rollover that you do. But basically, for those, you have to look at what type of person you are, what type of trader you are, and whether you are in a position to do sort of a damage control, or you want a very passive trade, so that because you are not able to concentrate much. So for those who are not able to concentrate too much, but at the same time looking at some big profits whenever it comes, and a small loss whenever that happens, then it is better to go for a butterfly type of spread, and pay something like 100, 125 rupees. That's all. Okay. So where probably the chances of your loss could be quite limited by the end of this end of the period. Now the same thing when it applies to your weekly situation also. See, now let's go to the trade year, and this is 30th means on 23rd. So let us say on so this is 23rd trade, and let us look at the 16th trade. So 16th it was 15,360, and It is 15,556. So you got 200 points, okay, and the option price for a single week right now is around 150 rupees or so at the money, okay. So here is the case that if you have done this trade, what you should do is that 150 rupees means normally it will not go much below 300 points, okay. That's a calculation that you have. Getting it much above 300 points is not a very likely scenario. Now if you go by the same logic, 23rd is 15,556. So the next week close, I think it will be less than 15,900 or so. It will be slightly less. It will be less than that. So assuming that you are looking at the uptrend right now, so better to do something like a 15.7, 15.85 and 16 call spread. That is call spread butterfly. 15.7, 15.85 and 16. Let us look at that. For 30th June, as things stand, 15.7 is 157, 15.85 is 187. So you get some 175 here, so you get some 18 rupees there, and 16,000 is 42. So you pay 24 rupees. So this is a so 15.7, okay, 15.85 and 16,000. Now why we are saying this is that yesterday the close was 15,560, right? So normally we expect 300 points, 15,860, and another 140, 150. So and also this is a very important Fibonacci level that we have talked. Now this is coming only for 24 rupees. This is coming only for 24 rupees. Okay. So when you do this particular trade, there's a chance that let us say the market starts to slip. So you're a little bit worried about it. Now let's do a 15.7, 15.6 put spread. In case if the market is to fall, whether if it goes below 15.6, whether we'll recover how much. So what we need is a 24 rupees to be recovered, right? So when the market goes between 15.7 and 15.6, we are going to get 100 rupees. 100 rupees. So our entire intention is that we just need only this 24 rupees to be obtained. So what we can look towards is 15.7, 15.6, 100 rupees. So what we can do is we can do maybe 50% or 25% of this trade, because if you do 50% of what you have done, so let us say you do 2 contracts here, let us say you do 1 contract here, 1 contract here, okay. So if it goes down, you will get 50 rupees. Now let's look at the 15.7, 15.6 put spread price. It is 160 and 120, so 40 rupees. So now it is 40 rupees. This is 40. This is 40. So what you will get for the full amount, you will get 60 rupees, right? If it goes down, because they have paid 40 rupees, 60 rupees. If you do 50% of this, you get 30 rupees, and that will compensate for what you have done. So what is the break even? Since you have paid, this is 40 rupees, and this is there are 2 contracts. Here is 1 contract. So you add for 40 rupees, 24 rupees. So 44 rupees. So anything very closer to the, even on the expiry day, when it is very, very closer to the 15.7, you will still make money. You will still definitely make money. And if it is closer to 15,800, 850, 16,000, you will definitely make money. So let us see how this trade works next, like next week. When we see, let us see how this trade works. If it works, then it's quite a fantastic thing that probably, for us. Because the same thing, if you see last week, if you are done expecting the market to go down, so you might have done something like on the put side. Okay, so now the market, when it went on the upside, you could have just recovered that money by doing the opposite trade. So whenever it just stagnates, you're getting some profits. So in between, for a very limited loss, you're looking at some profit that can be made. So this is another trade that you can do for a shorter period of time, because the decay can be quite fast. Since the decay is going to be quite fast, if the market stagnates around this price, you will see a good amount of profit coming quite fast. So a butterfly trade with an opposite. Suppose if you just want to leave this 24 rupees, fine, no problem. Just leave that 15.7, 15.85, 16. So what is very important while doing any of this option trade is that we must estimate to what extent the market is likely to close by the expiry date, for which we use the option price to know that. We are not looking at the chart or anything like that. The chart is used only to identify the trend. The trend could be down, but whether it is oversold or overbought is another important indication, because last week when the market was falling, it was getting into much of an oversold territory with respect to the option price that we are using it. See, in a single day, normally what happens, what is the option price? If it is going to be, if it is 150 rupees or so, a single day option price could be, so 1 divided by 7 into 150. Single day option price could be 60 rupees. Okay. So what you expect is that the market to be within 120 points. Normally the rally on a close to close basis, most of the time it should be something like you expect it to be 120 points. Some days it can be more, but it could be, we're expecting some 120 points. So let's take today also. Now let's look at the, see, yesterday close was 15,556. So approximately 120 points is 15,676. So it's almost only that. So when you do a 1:2:1, even in a single day, if you're done that, you would have done 15,550, 15,670 or so, okay, and then 15,800. Okay, the same thing would have done, right? So we must know to what extent probably the market can rally, okay. And even if you have done the trade with 60 points, yesterday 15,560, 620, 680, probably the loss could have been just 9 rupees or 10 rupees. On some days when it stagnates, you will make a good amount of money. So we must try, as far as possible, to look at trades based on that, because only thing is that what is very important is, generally when a trade is rallying like this, then in that case we can always expect that any rally on the upside is unlikely to be more than the option price. But because the fall, if it is there, then it can be because when it is reversing, then it can go to even more than twice of the option price close can happen. So that is the most important point that we need to know. So that is the reason why we are looking at some midpoints rather than the end points for knowing the to what extent the option the close can be. Now this was a rally year, so probably we could have expected something much more than the double the option price, but even this case it doesn't happen. So only in some cases it rarely happens. So we should be very clear that the overall trend, the corrective nature, to what extent it can go, and then what type of trade can be done after that correction happens, then what should be the stop loss that we should put, and what is it the money that we can afford, and whether we are going to be passive or active. So all these things will determine in doing an option study. So we have seen some, we will keep elaborating this so that you will also get more and more accustomed to that. So please note this particular trade which we have looked at for this week, 15.7 coming week, 15.7, 15.85 and 16 on the upside for 24 rupees as things stand today. And then they were doing a put spread for half that amount between 15.7 and 15.6 for the total amount of 44 rupees break even on the upside. And if it comes lower, below 15.6, we are not going to lose money. Let us look how this trade works. And also we have looked at when it comes to 16 or so, we will do probably a 15.6, 15,000. Right now we are looking at 15.7, 15 and 14.3 for July end. 15.7, 15 and 14.3. Let's see what happens to that trade, and this comes at 125 rupees cost. Or if it goes to 16,000, we will do the same trade, placing it at 700 rupees distance from that place. Okay, so now you can ask your questions. Nifty coming week trend, we have already mentioned that right now it's slightly in the upside, and the close next week could be below 15,950 or so, but it has an ability to rally up to 15,950 to 16,000, which cannot be ruled out. Now the fall, the change in trend can happen right now if it only starts dropping below 15,370 or 15,400 approximately. If it happens, then in that case we could see probably a shift in the trend. So this is where the Nifty trend is. Crude oil trend is definitely down. I think right now, crude oil is going down, so the trend is down. So thanks for your participation. So we will review all these things again. Thank you very much. Bye.